Hey everyone, welcome to the nitty gritty of real estate. We are on episode, believe it or not, 39. And today's episode is about loan types and why they exist. So why don't we get into it? Hey, welcome back everyone. Tom Krieger here with the nitty gritty of real estate, and I'm here with Sienna again from Guild Mortgage. And today we are going to talk about loan types and why do these certain types of loans exist? You know, what was the reason behind them? How can they benefit the general public? And really, Sienna, can you skip one and use another one for for your benefit? Are there some that, you want to stay away from because the requirements are too heavy? So let's, if you don't mind, I don't mind. Let's get into it.
Let's do it.
All right. So the first loan type that we hear out there is something called Freddie Mac. Mm-hmm. So tell me what a Freddie Mac loan is.
So Freddie and Fanny are both conventional loan types. So they were, they're the original financing before FHA, before USDA, before VA. So they were just they're the OG, right?
Okay.
There's guideline differences between Fannie and Freddie, but for the most part, they're both conventional. They're both the same. They just have a little bit of differences with certain things. So with Freddie, something may be a little bit more lenient than it is with Fannie. So depending on your situation, may direct us to go that way versus Fannie and vice versa. So
what would be, you said there's a little bit of difference. Give me an example. What would Freddie want that Fannie wouldn't? And then what would Fannie want that Freddie wouldn't?
So sometimes I'd say the most common example or the most common reason to switch to Freddie versus Fannie or go Freddie versus Fannie would be for like a self-employed borrower.
Okay. So like me, I'm a self-employed real estate agent. Okay.
Yeah. So it's a little bit more lenient on self-employed income and how it's calculated and how long it has to be going on. And so it's a little bit, I wouldn't say more lenient, but it's more workable. But I go Fannie plenty of times with self-employed borrowers too. Okay. So it just kind of depends, and also rates sometimes have a play in it. So depending on where the market is for Fannie versus Freddie that day, in most cases, it's not going to make a significant difference to most borrowers going Fannie versus Freddie. But like delayed financing is something that's a Fannie thing. Right? So if you're buying a house with cash and then you want to turn around and refinance it, delayed financing means you're allowed to finance it for the new appraised value within 6 months, whereas you wouldn't be able to do that if you didn't buy it with cash.
So would you use a loan like that? And, we're in such a competitive market right now, right?
Right.
So people don't want to take people with financing, right? Mm-hmm. So you could go in, if you had the cash, buy it in cash to get, to be put ahead of everybody else. And then later on, go back to Freddie or Fannie. Fanny, and say, hey, look, I want to now pull my, at least 80% out, right? And so I have that money because I want to put it in the bond market or whatever, right?
Yep.
So it could serve that purpose.
For sure. And it's there's delayed financing. There's also like the family opportunity loan that's a Fannie loan that allows a person to buy for like their child or their parents, like elderly parents or like children in school, which allows you to buy as a not necessarily a second home or investment property, but you can buy it for your kid or your elderly parents that don't qualify.
So if you did that, it would save maybe more money on a down payment. It may save like an investor rate versus a standard, right?
Exactly. Yeah.
So, but that would have to be, you'd have to qualify for that. It would have to be like my mom and dad where their Social Security doesn't make it up.
We have to prove that they don't qualify. Yeah.
Okay.
So whether it's like credit or income, there has to be documented. So that's like, there's cool things. Like that's something that puts Fannie separate from Freddie. I don't think Freddie has a program like that. I'm pretty sure it's only Fannie, but I mean, I guess I would have to do a little bit more research.
Well, wait till tomorrow because the Fed changes all the time, don't they?
Sure do. They sure do.
So let's talk about a USDA or what they call a Ginnie Mae
Okay,
type of
so
loan.
USDA, yeah. So USDA loans were developed for rural communities. So like originally it was like rural areas like farm towns to help provide affordable housing for those cities, those towns, those areas. So in Tucson specifically, there are, or not Tucson, but actually there are some little areas, but in the Tucson area, the greater Tucson area, there's a lot of USDA available properties. Those mean there's no down payment. They eliminate, or not eliminate completely, but it helps reduce the risk for the lender because they're guaranteed by the government.
Okay, similar to a VA.
Very similar to a VA, yeah. Except these ones are strictly for rural areas. There's there's income restrictions. There's there's a lot of pieces that go into USDA that are very different from Fanny, FHA, and VA. But it's a great product. It's a great loan type to have for these rural communities that need help developing, and people may not have a down payment, but if you're in this area, it really helps you qualify.
So I used to hear the term, they're farmer VA loans, like similar to what a VA would be, 100% down for a regular, like a service person, somebody who worked in the service. So it allows them for no money down. They're usually in rural areas. Like in Tucson, it would probably be out maybe where the cotton fields or the cotton farms are, those types of areas.
Yeah, so it changes every time that they do the census. So they'll change which areas need more development, right?
Okay.
And so yeah, it may not necessarily be where the cotton is, but it's where you can look up the map and you can see little like boxes of areas that are USDA.
Part of it is designed to basically stimulate development too.
For sure.
So it helps the farmers or people in those areas, but it also is designed to stimulate that area. So
stimulate
that really
the economy, yeah.
Okay, perfect. So let's talk about an FHA loan, which is, everybody talks about FHA, and I know in this business that sometimes FHAs can be great loans and sometimes they can be pain in the backside. So let's talk to me about the benefits of an FHA loan, and then talk to me about some of the restrictions. I'm going to use that term.
Okay.
In regards to like flipping and stuff like that.
Yeah. Okay. So FHA was developed also to help lower income families. So it's generally, I think, classified as like the classic first time home buyers program, right? Loan type, because it's a minimum down payment. It's 3.5% required down payment. And that's across the board with every FHA loan. The minimum is 3.5% down. Okay. There is a zero down, but it's really like a bond program where you're borrowing the 3.5% for your down payment. So FHA across the board is 3.5% down. So it's funny because it's more lenient, but it's also a little bit stricter at the same time. So you've got the anti-flip rule. So if a property, the current owner hasn't owned it for 90 days or more, then FHA, you can't qualify that property for FHA. FHA is also kind of cool or sometimes not cool because the appraisal follows the property. So if one person goes into contracts on this house and they get an appraisal and the appraisal comes in low, that same appraisal, the next person that comes in, if they're FHA, they use that appraisal. So they don't get the opportunity to reappraise the property for a higher value if both loan types are FHA. So in that scenario,
if you're looking to buy a house that, let's say, came back on the market, real estate market, your agent should contact the other agent and say, why did this come back on the market? And if you hear, well, it didn't appraise, your agent should go, okay, well, my buyer's an FHA buyer. There's no sense in wasting our time here because they weren't willing to adjust their price down to meet the appraisal, right?
Right.
So that's where the real estate agent has to be a little smart in that aspect of it too.
Okay. Or know what kind of loan type it was previously, because if maybe it was a conventional appraisal that appraised low, and then there's another opportunity to do a
reappraisal. Yeah. Okay. Great.
Yeah. But most of the time, I'd say when that happens, the listing agent, and you would probably know better than me, but I feel like most of the time they relist it and say like no FHA because they already know.
Yeah, so the listing agent like myself would look out for the best interest of the seller and say, look, at you know, we can't put FHA in here because we're just going to bring buyers in here. They're going to get upset.
Right.
Let's treat the public fairly. Right.
Okay. So with FHA, there's more, it has to be owner occupied. There's no option for non-owner occupied unless it's like a threeplex and you're going to live. You have to occupy part of the residence. So FHA is only designed for primary residence. It is not designed for anything other than primary, which is the same with USDA and VA and FHA. So all of these government programs, that's what they're designed for, is to help stimulate growth with maybe lower income, not necessarily lower income, but maybe lower income first-time home buyers. Maybe you don't have a big down payment. You don't have a lot of savings. That's what they're designed for.
Hey everyone, we want to interrupt this episode to let you know that we are a Keller Williams Southern Arizona franchise.
Also, we are licensed realtors practicing equal housing.
Now, let's get you back to the podcast. So you could buy 1 to 4 family unit as long as you live in one of the units and still have an FHA. So for first-time home buyers, that might be, hey, look, I'm not going to have my own residence, but if I could get a duplex, a triplex, or even a 4-family, those other rents could help me offset the mortgage payment. And in some cases, you could probably live there for free if you think about the rent being greater
I've
than the mortgage. Yeah. Okay, so you're smart at that. All right, let's move on to VA loans. Now, again, these are VA loans, not the farmer VA loans, but the regular military. And my hat's off to everybody who's served this country.
Absolutely, me
too.
So
thank you very much. So let's talk about those VA loans.
VA loans are amazing. They are designed for either retired or, veterans or active duty. As long as you have a clean discharge and you're still eligible for your VA benefits. 0 down payment. Depending on your circumstances, there is a VA funding fee that's part of, and that can be rolled into the loan. But if you're got any kind of military disability, oftentimes that's waived. So there's not even a funding fee. So literally, if you get seller concessions, where the seller is willing to pay, which I think our market might be turning around a little bit to where that might be an opportunity, right?
Yep.
Again, would be great. But you can come out of pocket with literally no money. I've bought 2 houses VA with my ex and had 0, got my earnest money back at closing.
Okay.
And so it's really cool. And then there's also, you can put a down payment. And if you put a down payment, it could reduce your funding fee that you have to pay as well. So VA is awesome. I think it's a great loan program. I may be a little bit biased to it because I've taken advantage of it a couple of times, and I really like originating them, and I like being able to help military. I mean, I like helping everybody, but for some reason, I don't know, VA's got a special spot in my heart.
Well, the same way our family was, had military in our family too. And personal opinion here, everyone, I don't think we do enough for our veterans.
I agree, 100%.
I think we need to do more for them. So part of the VA, you talked about this funding fee. What is that exactly, so people understand that?
So VA loans are backed by the government, and so the funding fee is it's the guarantee. It helps. It's so hard to explain.
Almost like an insurance policy.
It's insurance, right?
Okay.
So just the same as you have mortgage insurance on conventional loans if you put down less than 20%, and with FHA you're going to have mortgage insurance as well and an upfront premium. And USDA has their guarantee fee that's part of monthly. So VA just charges it all up front instead of a monthly guarantee. So it's kind of like insurance, but it's not insurance because it's not that loan program where they call it insurance, but it's similar. Yeah. Okay. And so sometimes that's waived if they have disability through the military. There was something, this is what I was going to say. And so like you said, how we don't do enough for our military is right now we're waiving or we're basically crediting back our VA buyers. We're covering their lender fees and their appraisal costs.
That's Guild Mortgage
Guild
is doing
Mortgage,
that.
yeah.
Okay.
That's what we're doing.
Wonderful. Thank you. Thank you
And
for
I don't know
doing
if
that.
it's all of Guild. I mean, I know for sure, like my region and my branch is doing it. We kind of like took the charge on that and was like, we want to do something this way.
Super.
So at least for the next quarter, we're going to be doing it. So through the end of September, we should be doing it. It may continue even further than that, but it's awesome right now. It's
Okay.
really cool to be able to just give that credit.
So a shameless plug here
For
for
sure.
for
No
Sienna.
shame.
You can call her if you're a military vet and get your fees paid back.
Yeah,
Okay.
for
All
sure.
right. Let's talk about the jumbo loan right now. And these jumbo loans, not a lot of people can take advantage of them because they're for big ticket items, but they are out there. Why don't you speak to that before we wrap it up?
Yeah. So jumbo is designed for anything that's over the conforming amount, which actually changes every year. So whatever doesn't fall within conventional standards, which this year is 548,250 for 2021, at least in our area. It's different in different areas, but most generally that's what it is. And so anything over that loan amount is going to be considered a jumbo loan, and they're designed for that reason. So they're not following Fanny and Freddie guidelines. Each investor kind of has their own guidelines. So like I personally have a whole matrix that puts them out side by side so I can see which one fits my borrower best. Because they're all going to have different, each bank is going to have how they want to write their jumbo loans and what restrictions and overlays they put in place.
Okay, so it's $548,250. That's the most amount of money you can borrow with an FHA
No, with conventional.
or with conventional. Okay, so that
FHA's
doesn't apply to the
max is-
FHA or the VA.
Yeah.
Any of that. So the jumbo loan is a conventional loan for high end.
Well, it's not conventional.
Okay.
It's
See how confusing it is, folks?
it has its own product type. So it's not conventional. It's for anything that's over 548,250, which is the conventional limit. So FHA's limits are 356,250. So 356,250 is the most you can do on an FHA loan.
Okay.
And then conventional is the 548,250. USDA. I think USDA has the same conventional limits. And then VA, fun little fact, actually doesn't have a maximum loan amount. And some banks will put an overlay on what their maximum VA loan amount is, but there's no technical max. You just have to do these formulas and make sure it works.
So it isn't just plug and play. Sometimes you've got to do a remix, right?
For sure. And so that's my thing is, like you were asking which product, a lot of times my clients will come to me and they'll be like, oh, well, we want an FHA loan. We're a first-time home buyer. And then they have great credit. They have a solid down payment. And I'm like, this probably isn't the best loan for you, but if that's what you want to do, here's a comparison, So it's always going to be their choice, but I'm going to lay out the options, everything that they can qualify for. They're going to know that, and then they can evaluate. I'll always make my recommendation, but that choice is theirs.
So everyone, that's it from the nitty gritty of real estate here. Next week, episode 40, we're going to be talking about what's happening right now in the real estate market, because there's some things changing. Until then, America, stay safe.
Hey, thank you for listening and watching the Nitty Gritty podcast here with the Tom J. Krieger team. If you are thinking about buying a home, selling a home, or even investing in real estate, please reach out to us. We are local here in Tucson, Arizona, but we are also connected to over 4,000 agents across the US. So again, looking to buy, sell, or invest in your hometown, reach out to us and let us connect you.